For more on today's price action and what we can expect in Treasuries going forward, I'm joined by Ian Lyngen, a senior government bond strategist at CRT Capital Group, and he joins me now from Stamford, Connecticut. Ian, always good to have you here on Fast Forward. It's a shocker when the 10-year yield gets below 2%.
That it is, Lisa. We were pretty surprised to see a one-handle midday, and what really pushed us over the edge in the morning was the weaker than expected Philadelphia Fed print at negative 30 plus. Was the lowest that we've seen on that release since March of '09, and it's consistent with building expectations for a below 50 ISM print for the month of August, which is obviously a bullish risk to the Treasury market. And it's also consistent with the broader ratcheting down of growth expectations globally as well as here domestically.
Ian, CPI came out stronger than expected. Does that suggest that there are some inflationary pressures here in the U.S.?
It was a bit of a mixed bag, actually, because the headline CPI print was higher than expected, but it was primarily driven by energy prices. And with core coming in line with the expectations up 0.2, the question then becomes, are the elevated energy prices going to work as a tax on the consumer and actually constrain overall growth, or is it a situation that leads to core inflationary pressures? From what we've seen, the Fed certainly isn't worried about the core inflation measures, and while the data might be inching up closer to the Fed's soft target of 2% on the core measure, it certainly hasn't influenced monetary policy.
Do you think at this stage, Ian, that 10-year yields are pricing in the likelihood of QE3 either by the end of this year or the beginning of, say, next year?
They certainly are pricing in the risk of additional bond buying by the Fed. I think more immediately they're pricing in some substandard, some sub-trend growth in the U.S. market. If you look at expectations for Q2 GDP revisions next week, it's very conceivable that we see a measure below 1%. And with below 1% GDP, the Fed on hold for the foreseeable future, I think that the possibility that the Fed does expand their balance sheet further is definitely on the mind of market participants.
And then how much of the rally that we have seen in Treasuries is just fear? I mean, is just that safe haven trade?
Well, there are a lot of reasons to be nervous globally, given what's going on in Europe with the potential euro bond kind of pushed to the back burner for the meantime, problems with the funding of the second round of the Greek bailout, people looking for additional collateral. I think that there is enough concerns globally that flight to quality to treasuries continues to be a theme, and we're certainly seeing it against domestic equities as well, with the stock market continuing to trade well off of the recent highs.
Ian, do you think there's some real risk that we could see yields snap back pretty quickly here, particularly on the long end?
Well, the long end is more than 30 basis points better than the auction stop last week for the new 30-year. And so the idea that we might be in for a short-term correction does have merit, but I would caution that the 5s, 10s, and the 5s, 30s, and 10s, 30s curve had gotten so steep that what we're really watching now is a bit of a correction of that steepness. And so there might be some slowing of the flattening of the curve, but we still look for additional flattening in 5s, 30s, and 10s, 30s.
All right. Thanks so much, Ian, for joining us today. Appreciate you taking the time. That was Ian Lyngen, senior government bond strategist at CRT Capital Group, suggesting that we could see some more flattening between 2s, 10s, and 30s. Okay, well.